Welcome back to the Deep Dive. Today we are taking a really fascinating look at a company that is making one of the biggest, fastest strategic pivots in the semiconductor space right now.
That would be Marvell Technology, Inc.
MRVL, that's right. Our mission today is to take you straight into their Q3 fiscal 2026 results. They just closed on November 1st.
And we're looking at two big things.
Exactly. First, how they managed to engineer this just a spectacular financial swing on their balance sheet. And second, how they are betting all that cash on what they think is the single most important component for the next generation of AI.
It's a huge story, shedding weight to make an even bigger bet.
An aggressive bet.
It's a masterclass in strategic redirection, and, the numbers really tell that story. If you just glance at the headlines, Marvell hit a net revenue record.
What was the number?
$2.075 billion for the quarter. That's a very healthy 37% increase year on year. But you really have to look at the bottom line to see what's going on.
The real transformation.
Right. They swung from a massive net loss of $676.3 million in Q3 of last year to a huge net income of $9,901.3 million this quarter.
That is nearly $2 billion in net income. And the JAP diluted EPS number? It just flips from negative as dandy 78 cents to printing a staggering $2.20 per share.
It's an incredible swing.
Now, if that growth were purely operational, it would imply they invented a perpetual motion machine or something. But this story is much more interesting than that.
It is, and you hit the nail on the head. That massive swing was overwhelmingly driven by strategy and structure, not just increased chip sales, although, the sales were good too.
Okay, let's unpack that anatomy then.
Yeah.
That net income figure is the eye-catching number. Where did that $1.9 billion windfall mostly come from?
It came from a really decisive move to, rationalize their business portfolio.
Okay.
The cornerstone of that swing was the divestiture of their automotive Ethernet business.
Right.
Marvell recognized that, while that segment was established, it wasn't core to their future. Their focus is on high-speed data center and AI.
So they basically decided to sell a solid non-core asset to build up a war chest.
Exactly. They completed the sale early in the quarter, specifically on August 14th, 2025. That one transaction brought in $2.5 billion in cash.
Wow.
And, critically for the financials, it created a pre-tax gain on the sale of $1.8 billion. That gain is what dramatically inflates the net income figure we were just talking about.
So they were effectively cleaning house and getting paid handsomely for it.
A very handsome price.
That explains the huge net income, but I want to look underneath that one-time gain. What about the core business health? The gross margin performance saw a massive improvement, jumping, 28.6 percentage points? That's just real structural improvement, doesn't it?
It does, but again, context is absolutely everything here.
Okay.
Gross margin improved to 51.6% in Q3, up from 23.0% the year before. And while, better cost absorption from higher revenues definitely helped, the biggest factor was simply the non-recurrence of charges they took last year.
The balance sheet cleanup.
Precisely. In Q3 of fiscal 25, Marvell did this major restructuring that forced them to take significant asset impairment charges.
How much?
In total, about $356.8 million. Think of it as swallowing a massive one-time financial pill.
Got it.
So because those charges didn't happen again this quarter, the gross margin looks spectacularly better by comparison. So yes, operational progress is real, but that huge margin jump, it's really the story of a cleaner financial slate.
And we can see that story play out clearly in their operating results, which, strip out things like that massive $1.8 billion sale gain.
Right.
Operating income actually shifted into the black money, moving from a loss of over $700 million last year to a solid income of $357.8 million this quarter.
And those restructuring charges were way down.
Way down. From $358 million to just $9.6 million. It just paints a perfect picture of a company moving out of a heavy restructuring phase and into a streamlined, high-growth one.
And that cleaned up balance sheet, that $2.5 billion in cash, that is now funding the future. The real drama of this deep dive is what Marvell is buying. They are making a massive, multi-billion-dollar commitment to owning the infrastructure layer for the largest AI clusters.
And that takes us immediately to the headline-grabbing event, the plan to acquire Celestial AI, which they announced right after the quarter closed.
In December 2025, yeah.
So what exactly does Celestial AI do, and why is it worth, potentially, $5.5 billion?
This is where it gets really interesting for anyone tracking AI infrastructure. Celestial AI specializes in a breakthrough technology they call photonic fabric.
Photonic fabric.
And this platform is custom built for what's known as scale-up optical interconnects. The key driver here is that these immense AI training clusters,
Yeah.
think of the most powerful systems run by the hyperscalers.
Right.
They're quickly moving beyond single-rack setups to multi-rack configurations.
And when you move to multi-rack, you're asking for extremely high-speed direct connections between, hundreds or thousands of XPUs, these specialized processing units.
Exactly. That transition demands high bandwidth, ultra-low latency, and critically, an any-to-any scale-up fabric. Protocols like UA-Link are driving this.
And copper can't keep up.
Copper interconnects. Even today's optical links, they're struggling to meet the power and latency demands. The system it demands light, not electricity, for that kind of internal communication.
So Marvell is essentially buying the technology that replaces those traditional electrical pathways with light inside the massive cluster. But what makes Celestial AI's specific photonic fabric the key differentiator?
It's all about efficiency and integration, and specifically solving a major thermal hurdle. Celestial AI is claiming over 2 times the power efficiency of comparable copper interconnects.
Which is huge in a power-constrained data center.
Huge. But the key technical advantage is its thermal stability. This lets their photonics technology be co-packaged vertically.
Vertically, as in stacking.
Stacking. Right on top of high-powered chips like XPUs and switches, all inside a single 3D package.
Okay, let's break down that co-packaging aspect. Why is solving the thermal stability of photonics inside the package so vital for these AI chips?
Well, think of the chip die edge as like beachfront property. Traditionally, you need all that edge space to connect thousands of electrical wires. The input-output, or I/O, it's incredibly inefficient. By moving that I/O to these ultra-efficient co-packaged optical links,
You free up the beachfront.
you free up the beachfront, and that newly freed space can be used for the most valuable bandwidth-hungry component, high bandwidth memory, or HBM,
And more HBM directly means faster AI training.
which is the holy grail for hyperscalers.
That makes the technical breakthrough much clearer. It's not just speed, it's about redesigning the physics of the chip package to maximize memory access. And the performance metrics on their first products they're wild.
They are. Celestial AI's first photonic fabric chiplet delivers an unprecedented 16 terabits per second of bandwidth in a single chiplet.
And just for context,
To put that into perspective, that's 10 times the capacity of today's state-of-the-art 1.6 terabit ports used in most current scale-out applications. This is truly next-generation stuff.
now let's look at the financial commitment. They sold their automotive business for $2.5 billion, and they are leveraging that cash almost immediately.
Correct. The upfront valuation for Celestial AI is $3.25 billion. That's
Yep.
paid with $1.25 billion in cash and $2.25 billion in shares. But the terms show just how high stakes this bet really is.
How so?
There is a contingent earnout of up to $2.25 billion more, paid in additional shares, and it's based entirely on performance.
So a potential $5.5 billion deal with almost half of the value dependent on results.
Right.
What's the benchmark for earning that maximum payout?
They have to hit cumulative revenue milestones, specifically exceeding $2 billion from Celestial AI's tech by the end of fiscal year 2029.
That's an aggressive timetable.
Extremely. Marvell is projecting meaningful revenue to start in the second half of fiscal 2028 and, critically, reaching a $1 billion annualized run rate by the fourth quarter of fiscal 2029.
That 4-year timeline it's incredibly fast for integrating a technology this revolutionary.
It is.
So before that acquisition closes and the future revenue kicks in, let's quickly anchor ourselves in the current quarter's operating health. Where is the existing $2 billion in sales coming from?
Data center. Without question, it is the engine of the existing business.
What percentage?
It was a huge 73% of Q3 revenue, over $1.5 billion. Sales there increased 38% year over year, and that's driven by powerful AI-related demand for their custom silicon and their electro-optics portfolio.
So the foundation they're now building on with Celestial AI.
Exactly.
Data center is the driver, but the traditional infrastructure segments showed a major bounce back that we haven't seen in a while.
That's the recovery story. Both carrier infrastructure and enterprise networking showed very strong year-on-year recovery. Carrier was up a stunning 98%.
98%.
And enterprise networking was up 57%. This is really because customers finally burned through the excess chips they bought during the supply crunch. Inventory levels are normalizing.
Right.
And that's coupled with strong adoption of their newest products.
And on the other side of the strategic shift, Automotive and industrial sales naturally fell.
Yes, that segment decreased 58% to just $35.0 million. This is the direct expected outcome of selling off the automotive Ethernet business. They successfully shed the weight they wanted to lose.
Now, shifting to risk, one number consistently jumps off the page when we look at Marvell. Customer concentration. What does that look like now?
The concentration risk is still very high, which is, it's pretty typical for a company servicing hyperscalers and major distributors. The sources tell us that 70% of gross accounts receivable was concentrated with just 3 customers.
2 customers.
Just 3. And we even have specifics. Distributor A was 38% of Q3 net revenue, and a single direct customer A was another 11%.
So what does that kind of concentration really mean for you, the listener? It's not just a high number. It implies a real vulnerability.
Exactly. It means Marvell's ability to hit its quarterly targets is highly dependent on the procurement schedules and roadmaps of a handful of giants. If even one of those 3 customers pauses an order, adjusts the projection, or demands aggressive price cuts.
Marvell feels it immediately.
Immediately. It puts them in a tricky negotiation position, and it introduces a massive execution risk that is totally outside their direct control.
Okay, let's look at capital allocation. Given the huge cash influx, cash and equivalents ballooned to $2.7 billion, how aggressive are they being with shareholder returns?
Exceedingly aggressive. The board authorized a staggering $5.0 billion addition to their stock repurchase program in late September.
$5 billion.
And to execute quickly, they immediately entered into a $1.0 billion accelerated share repurchase, or ASR, agreement.
For those unfamiliar, an ASR is essentially front-loading the buyback, correct?
It is. Instead of buying shares gradually on the open market, Marvell just handed $1 billion to a bank and got an initial delivery of 10.7 million shares right up front.
It signals confidence and speed.
It does. And as of quarter end, $5.7 billion was still available for future buybacks. So overall, they returned $2.0 billion to stockholders in just the 9 months leading up to November 1st.
That is a colossal return commitment, especially when it's happening at the same time as a massive acquisition.
It's a lot to juggle.
Okay, let's pivot to the external landscape, the regulatory and geopolitical risks they have to navigate.
The source material highlights some critical external factors. First, geographic concentration. 77% of Q3 net revenue was shipped to customers with operations in Asia.
And that's compounded by where they manufacture.
It is. They rely heavily on third-party foundries, mainly concentrated in Taiwan and the broader Pacific Rim.
That puts Marvell right in the center of the global supply chain discussion and, frankly, geopolitical risk.
Absolutely. This concentration exposes them to significant risks, everything from natural disasters to political or economic instability in a very sensitive region. The entire pipeline really hinges on stability there.
And what about the regulatory environment, specifically on the tax side? It looks like there are some major changes with both positive and potentially negative implications.
Yes, and we have to note these 2 developments impartially. On the domestic front, the One Big Beautiful Bill Act of 2025 was signed in July.
And this is favorable for chip companies.
Highly favorable. It made permanent the domestic research cost expensing rule and 100% bonus depreciation.
And what does that permanent R&D expensing mean in practice?
It's a huge benefit. Instead of forcing companies to amortize or, spread out their R&D spending deductions over several years, they can deduct those costs immediately.
The same year they spend it.
Right. This dramatically lowers their taxable income, increases immediate cash flow, and it rewards them for domestic innovation.
But on the international side, things are more complicated.
On the international side, yes, Marvell is subject to the OECD's 15% global minimum tax regime, known as Pillar 2.
And why is Pillar 2 a potential headwind?
Well, Marvell, like many multinationals, benefits from specific foreign tax incentives offered by governments to encourage investment. These might push their effective tax rate in those places below 15%.
Okay.
Pillar 2 essentially says, if your rate is below 15% in any country, you owe the difference back to bring it up to that global minimum. This could significantly reduce the benefit of those existing incentives and, increase their global tax bill.
Yet they are still benefiting from some targeted government support, right?
They are. The sources note that Marvell is getting new government incentives approved in May 2025 in a foreign jurisdiction. These incentives reduce costs of sales and operating expenses.
But they're conditional.
Contingent on them meeting specific investment levels through early 2030. It shows the company is successfully navigating that whole carrot and stick landscape of global taxes and subsidies.
Okay.
So if we synthesize this deep dive, the narrative is crystal clear. Marvell has aggressively monetized a non-core asset, that automotive business, to generate a ton of cash. That cash is immediately being deployed to both reward shareholders through a massive buyback and, most crucially, to make a high-stakes, multi-billion-dollar bet on securing a leadership position in AI connectivity with the Celestial AI acquisition.
The focus is squarely on future-proofing their data center business.
For the era of AI hyperscale.
It's a bold, high-wire act built on spectacular execution. They need to integrate a game-changing technology and deliver a revolutionary product roadmap, all while balancing these intense financial commitments and substantial external risks.
It's a very tall order.
Which leaves us with this final provocative question for you to consider. Marvell has committed to delivering a monumental $1 billion annualized revenue run rate from the breakthrough Celestial AI technology in just 4 years.
Wow.
Given the inherent technical execution risk of integrating this technology, coupled with Marvell's intense reliance on a highly concentrated customer base, 70% of gross AR tied to just 3 customers, and their critical concentrated manufacturing exposure in the geopolitical hot zone of Taiwan and the Pacific Rim.
That's a lot of risk.
How will Marvell manage the intersection of these massive execution and geopolitical risks as they race to hit that ambitious target? That's a fascinating challenge for the coming years.
It really is.
That's all the time we have for this deep dive. We hope you feel thoroughly well informed. We'll see you next time.